There is absolutely no doubt that China has accumulated huge amounts of gold off balance sheet. And not only that, but she's encouraged her citizens to accumulate gold as well. And I think they know that at some stage they're going to have to protect their currency by putting it on a gold standard. But they don't want to do that too soon, because if they do that, they will destroy the Western financial system, because immediately everybody in BRICS will go and do the same thing. So the situation, I think, is actually quite delicate. And this is one of the reasons why I think the timing, if you like, of the collapse of the currencies could be a bit closer than we think, rather than a long drawn-out procedure.
We present the clips of Alasdair's latest video. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Join our WhatsApp channel for real-time updates, breaking news, and expert predictions on gold, silver, and financial markets. Link in the description or pin comment. Stay ahead of the curve. Don't miss out.
It's quite hard to separate out the two, I think. I have no doubt that, in America, there is this sort of view. It's a very sort of domestic view that the dollar is, that's what we account in, and nothing else really matters. And the idea that, the Fed, if you like, should try and manage things in the light of the effect on the dollar is wholly alien, I think, to individuals in America. They don't understand, I'm sure this is right, they don't understand the dynamics that drive the dollar against other currencies, except to the extent that so long as the dollar is the numero uno of currencies, then what are we going to worry about? So I think it's quite simple. As far as the BRICS countries are concerned, they're in a very difficult position because America is extremely powerful. They owe money in dollars where they owe money, or currency rather, and consequently they don't want to upset their bankers. So they're not in the business of running around and telling everybody how awful the American government is and how they're destroying their currency and all the rest of it, and we're going to sell it off. No, they would rather keep quiet at things. Now, a very good example of this is India. India does a huge amount of trade with the West, and it's not in its interest to rock the boat on currencies at all. And it's only recently, actually, that India has sort of decided to start protecting herself by accumulating gold reserves. And, they haven't finished doing that. I mean, it's quite clear to me that they need to get their reserve position up even further. The reason I think that India's got left behind is that it's gone through a period of Keynesianism, informed by us, because we've been responsible for the appointment of governors of the Reserve Bank of India. That's something which the Bank of England has always been consulted on. In other words, it's someone who we approve of, or the Bank of England approves of, ends up being governor. And by definition, that's someone who follows the same sort of economics, if you like, that the Bank of England and the UK Treasury follows, which is Keynesian. So, or neo-Keynesian, if you want to put it that way. So, countries like that, I do think have a problem. They know that the Western system is dying on its feet, but they can't sort of just break away from it completely. I think that this, if you like, feeds into the problem that China has, because there is absolutely no doubt that China has accumulated huge amounts of gold off balance sheet. And not only that, but she's encouraged her citizens to accumulate gold as well, which they have to the tune of something like 27,000 tons. These are huge numbers. Not very much on a per capita basis, but huge numbers nonetheless. And as far as the Chinese are concerned, I think they know that at some stage they're going to have to protect their currency by putting it on a gold standard. But they don't want to do that too soon, because if they do that, they will destroy the Western financial system, because immediately everybody in BRICS will go and do the same thing if they're able to, or they will try and link themselves to the Chinese yuan, again, to protect themselves against the accumulation of follies that we've perpetrated on ourselves and therefore on everybody else. So the situation, I think, is actually quite delicate. And this is one of the reasons why I think the timing, if you like, of the collapse of the currencies could be, a bit closer than we think, rather than a long drawn out procedure. I mean, we've seen the purchasing power of our currencies decline over huge amounts over long periods of time. I mean, I would say if you look at the relationship between the pound and the sovereign, I mean, originally £1 was one sovereign, and you could exchange a paper pound for one gold sovereign. There are now 550 paper pounds for one sovereign. Now that is a huge, great loss of purchasing power for the sovereign, for the pound. And other nations, have had exactly the same experience. I mean, if you look at the way in which the purchasing power of the dollar has gone down since it was 35 to the ounce, it's now close to 3,000. Mm-hmm. You've got, the yen has gone way down. The euro and its previous constituents has gone way down as well. I think that's around about 1% of where it was. So, these losses are now likely to accelerate from here, which I think is really quite catastrophic. Well, it depends on the audience. Where I've been invited into a central bank, I don't actually say, get the hell out of credit, which is what I would basically say to an audience, if you like, of investors, of individuals. But really, I mean, the answer really is that if you agree with me that it looks like credit is going to decline in its terms of its purchasing power at an accelerated rate, which, if you like, conventionally we would say inflation is going to pick up again, then you really want to get into something which is stable. And of course, money, in terms of its purchasing power, by which I mean gold, has been stable over millennia and will continue to be so. I think gold at the moment is beginning to discount some of the future collapse of the purchasing power of currencies. But you would expect that at a time like this. And this is certainly reflected in the fact that gold is leading by quite a margin the rise in commodities, and particularly metals. So if you look at, copper has begun to move higher, for example. But if you look at many other commodities, the sort of commodity complex is only just sort of beginning to turn round and is beginning to look sort of interesting in investment terms, as it were. But the fact that gold is so far ahead, I think, is a clear indication that that is the direction in which everything is going to go, which, of course, reflects the fall in the purchasing power of currencies. That's really all that's happening. I mean, when you see copper rise, when you see nickel rise and all the rest of it, and silver as well, it's loss of purchasing power of the currencies being reflected in those commodities, not necessarily demand for those commodities. And I think this is the point which analysts thinking in terms of constant purchasing power for dollars, because they account in dollars or sterling or whatever it might be, this is a point they all miss. They don't understand that actually what's happening is it's not commodities going up, it's the currencies going down. And that's going to be the major driver, I think, for commodity values in the coming years. Look at it purely from the point of view of any trading entity. If your equity is wiped out by losses, mark-to-market losses, if you like, or even trading losses, then you are trading fraudulently, and indeed is a criminal offence in most countries to do so. But that is the position which all central banks are in today. And of course, as you imply, people don't worry about this terribly because they say, well, they can always print more currency. Well, that is obviously true. And it's been particularly true if you look at the situation of the Bank of Japan, whose equity is so far underwater. I mean, because the Bank of Japan owns roughly 60% of Japan's debt, the JGB market. This is enormous. And so, the equity, I mean, last time I calculated, I mean, the figures are not that material, but it was something like 40,000 times underwater. I mean, the equity was so insignificant compared with the losses. The second thing people say is, well, there is always the other backstop, and that is that central banks are owned by governments. They're a government agency, and so they are backed by the, if you like, the tax revenues of government, ultimately. Now, that as an argument is pretty specious, because if you look at certainly the US, you look at most of the European countries, so we'll take it as the EU as a whole, the UK, and also Japan, these countries, these nations, these units are in debt traps. In other words, their economies are not growing sufficiently to pay down the debt, or if you like, to cover even the interest on the debt. Now, under those circumstances, this is called a debt trap. And inevitably what happens is that the lenders, if you like, the creditors, demand a higher interest rate in return for this extra risk. Now, this is particularly apposite at the moment, because if you look at the US economy, it's stalling. It is actually, I mean, on any sensible calculation, it is actually going backwards. The private sector is contracting. Now, the reason I get there is quite simple. And this is on official figures. The Congressional Budget Office's own figures say that the US economy is growing at 4.5% in this fiscal year. But the budget deficit is 6.5%. Take 6.5% away from 4.5%, and so you've got a private sector which is contracting by 2%. Now, that's in nominal terms. As well as that, but if you take the official rate of inflation expected by the CBO at 2.9%, you're looking at a contraction of 5%. Now, we can calculate it for this year. You can also do the same calculation for the previous year, and the year before that, and the year before that. And of course, the COVID year was a real economic disaster for the private sector. So I think what's happening is people are beginning to understand that this is the problem. So in effect, you've got a contracting private sector GDP, which is meant to support this increasing level of government debt, which in the US case is increasing by roughly $2 trillion a year. So where is the revenue, if you like, to back all this? The revenue isn't there. So you've got, on the one hand, you've got the revenue diminishing. You've got that debt to GDP ratio. This is, this works out of the GDP actually contracting, if you look at it, taking that distortion of extra government inflation pushed into the GDP. Consequently, the idea that there is the backing for central banks is just not true. The ultimate backing isn't there. And we have to tie this in with the credit bubble. Most people don't really understand they're in a credit bubble, but you've only got to look at the other side of credit. Look at debt. Oh, yes, we're in a debt bubble. We all know that. So if we're in a debt bubble, we are in a credit bubble. And that credit bubble is the biggest ever seen in the history of the world. So that is now beginning to topple over.